Good morning, Jags. This is Fahad. Today is Wednesday, January 27th. Let's get started. It's time to push some brakes and take a little bit risk off the table and get a bit more defensive. Now, I mentioned this in the webinar yesterday too, but I would like to cover a whole bunch of market internal charts this morning to show you a picture. I've said this many times in webinars and chat rooms and other places that the absolute picture of the market internals that we show all the time in the first trade is not as important as the trend of these market internals. Once again, the absolute picture is a static picture, doesn't tell me anything. It's the trend of the market internal that tells me the story. And when the trend is deteriorating, doesn't matter we're coming out from overbought conditions or not, it's the trend that worries me. And here's what we're seeing in the market internals. Here's the NIMO picture. Yesterday, when everybody was enjoying those big fat gains on the most highly shorted names that everything was running so sharply, we saw continued deterioration in the market internals with NIMO coming down sharply, falling by 10 points yesterday and closing at a level of minus 30 yesterday. If you look back since last week, which was a high point of 15, positive 15 reading, NIMO has been consistently deteriorating since then. Put this picture, NIMO picture, in context of what we saw in November and December. Back in November 2, NIMO continued to deteriorate sharply. Then we had sort of like a dead cat bounce, and now we're starting to take essentially next leg down. This next leg down in NIMO could potentially take us all the way to minus 80. It's the trend that is deteriorating. Next one. This is NYSE. Whenever NIMO is rolling over, the accumulative patterns or the summation of NIMO is called NYSE. We got the bear cross. The second time we got the bear cross yesterday. This was the first bear cross here, and this was the second bear cross after market close yesterday. This is clearly now trending to the south, to the downwards. And if NIMO is going to continue to go down with a minus 40, minus 50, and take a look at the S&P futures today, which are down more than 40 points, you're going to see NYSE will continue to come down. 600, 400, 200, zero line. I don't know how long this will continue, but this is clearly trending down. Next one. Again, the trend is what matters. For a long period of time, for almost 2 months, the percentage of stocks in the S&P 500 index as well as in the New York Stock Exchange. There are 2,800 stocks in New York Stock Exchange. For 2 months, the percentage of those stocks trading above their 50-day moving average was holding steady around 85 line. Again, the absolute reading doesn't matter. It's overbought, I get it, but that doesn't matter. It could stay overbought for too long. But when the trend changes and the deterioration becomes alarming and becomes very clear, is what catches my attention. So now you look at that trend of the percentage of stocks trading above the 50-day moving average at the NYSE. For 2 months, they were flat and overbought, but now they're finally starting to come down. And this all started to happen from last week. We were at 85, gradually went to 82, 80, 81, 80, and then yesterday we went more selling, and now it's a 75. And with the gap down that is expected today, this thing is probably going to see 65 or maybe even lower. Similarly, if you go to the S&P 500 index, which has 500 stocks, you see the same exact picture. The percentage of stocks at the S&P 500 for 2 months flat, very, very strong markets, but now are starting to roll over. It's the trend that matters. The absolute reading doesn't matter. And then finally, this chart. I showed this in webinar yesterday, and it's worth showing again just to kind of remind you, what I'm seeing from my perspective. What is this chart? This is the picture that comes from RBC Capital sentiment note from 2 days ago. They point out something very, very interesting. They pointed out that one of the best ways, one of the best gauges to read the investor's sentiment is to actually see whether the percentage of upward revisions in the earnings per share has reached its peak or not. Meaning if you're starting to see a decelerating trend in the upward revisions that we are seeing in the S&P components, 500 components by the street collectively. And if you're seeing constantly with the improving economy, the upward revisions coming in stronger and stronger, naturally that means the sentiment on those stocks will continue to improve. But if you start to see a pattern where everybody has baked in enough into the forward-looking outlook, whether it's for fiscal year 2021 or even beyond, that the upward revisions have slowed, and you don't see them raising forward earnings estimates as much as much as they used to in the past. That means the sentiment essentially around the earnings have started to peak, and that's exactly what we are seeing now too. They're pointing it out that only 4 times going all the way back to last 20 years, we saw a reading of this index reach above 70%, and each time when that happened, essentially the market peaked temporarily short term, and we started to see decelerating trend. Put it differently, the pandemic and the reopening theme and all that has caused enough that the industry, that the whole Wall Street has already re-rated so many stocks already that they're baked in as remarkable recovery for fiscal year 2021 and beyond already into their fiscal year 2021 or even 2022 estimates. That now when those earnings come out, we don't see surprises. We don't see them surprise at all. And that's what we're seeing recently as well. Last week, as I mentioned in webinar yesterday, we saw that approximately 14% of the S&P 500 companies have reported earnings so far, and yet only 22% of those S&P 500 companies saw their stocks actually rose by at least 1%, despite the fact that we are seeing record amounts of sales and EPS beats on the street. We're seeing record amount of sales and EPS beat during this earnings season. 14% of the S&P 500 companies have reported, but only 22% of the stocks actually react positively to those earnings, while a fair majority, 78% of the stocks saw actually sell off despite reporting huge beats and raises. This morning, this is happening again. If you look at Advanced Micro Devices, which closed at $94.71 yesterday, it's gapping down at $91 per share, after reporting a fantastic quarter last night with a clean beat and raise. Texas Instrument had a remarkable quarter last night, and this thing is going to gap down by about $4. And you're going to see far more of that because we're going into a very, very active calendar of events. So putting this entire thing, the sentiment in context, I think it's time to get a little bit defensive. So I'm just going to quickly let you guys know what I am doing. So when the market opens today, I'm going to be buying this hedge. I'm going to be buying in SPY March 375, 350, 325 put butterfly spread. That's a $25 strike put butterfly spread. That is SPY March 375, 350, 325 put butterfly spread, which closed yesterday at $2.38. I'm going to try to get a fill on this one for $2.50 or less as the market opens today. So I will be putting on this hedge today. Just think that we need to protect to the downside. One last thing I will show you is that when you look at the S&P chart, if the market comes in, here's the S&P chart. If the market comes in a little bit, where could we find ourselves? Where could we find the support? I believe that about 50% retracement of this entire rally since the election time, and that at that time the S&P was around 32.75. Now we're 38.75. You may break down from this trend support, and a 50% retracement actually takes us all the way to about 35.50 to 35.75, roughly around this level. Okay. And so that would be a 50% Fibonacci retracement. Let's see if we're going to go to that. That would be about this level, looking at this chart. All right. And that's why the hedge that I will be buying this morning is March 375, 350, 325 put butterfly spread for 250 or less. That's it from me. Let's go to Jay. All right. Not sure if Jay is here. Let's go to Chronicle.
Morning. Today I have an update on Manhattan Associates, ticker MANH. First laid out the bull case for this warehousing solutions company on July 7th last year, and when the stock was around $90. And then I reiterated the bullish call on October 17th. So this idea has been working over the last couple of months after a lot of chop. Perhaps my timing could have been better on this one, but I wanted to bring this up today because the company is going to report next Tuesday, and Truist was out with a note yesterday with some qualitative channel checks as well as a price target raised to $136 from 120. So here's the gist of the note. First thing is their analysts recently spoke with various consultants that work in supply chain transformation. And what they found was broader than expected adoption of the company's cloud warehouse management solutions, which was first released in May last year, which I already talked about in detail in that conversation recording back in July. But basically, what Truist is implying here is a strong increase in the number of wins as well as sustained momentum continuing into January in terms of bookings. And the reason why this continuation of strength so far in Q1 is bullish is because number one, this is multi-year revenue and cash flows we're talking about. And number two, it also implies strong remaining performance obligation, which in turn leads to cross-selling opportunities to further drive the cloud subscription revenue over the next several years. Just a reminder, this company is the first mover globally when it comes to cloud-based warehouse management solutions. So they have the advantage here. And personally, I'm still seeing news about a lot of supply chain pressures that have persisted into the new year because e-commerce demand continues to be elevated. And so putting everything together, Truist has not only called for a beat in this upcoming earnings report, they've also tweaked their earnings estimates higher, not just for 2021, but also 2022. And then one last thing to mention here is that judging by how earnings have gone so far, I wanted to reiterate what you were saying, Fahad, that what we're noticing is that even though many companies have been reporting beats on Q4 as well as guidance, a lot of the times the stocks haven't been reacting positively post earnings. A lot of them have been going down despite strong numbers. So keeping this in mind, I would not be surprised if this company reports fantastic numbers and guidance and the stock still drops, just like the last time the company reported. But I continue to believe that any material declines in this stock will be a buying opportunity.
Very interesting update. On a technical note, this Manhattan Associates, unlike majority of the other market, had been actually flat for a long period of time. 6-7 months is a long consolidation period, which covered two earnings reports, back in July and then once again in October. And only recently, since the start of the year, this has started to actually break out on rather heavy volume and such. So arguably this isn't exactly as frothy, purely technically speaking, as we would see in some other places in the market. And secondly, I think the bull case is quite strong fundamentally. I think there's reasons to like this name for the very things that you just mentioned. And this is, by the way, the third time we are covering the bull case in Manhattan Associates. The first one was on July 7th. If you simply go to Jaguar Media and you search for symbol MANH, and you will see, and then the second time was on October 17th. So I think that it's finally starting to play out, but it took a long time. So if there is a pullback post earnings, just like the rest of the market, maybe 110, and then that's all we're looking at. And then from there, a few days of basing formation and then another bounce. So that's how I would read this chart and the fundamental picture. Good stuff. Let's go to Jay.
Hi, morning, everyone. All right, so yesterday in chat, actually in the comment section, one of our clients asked about a name called Drive Shack. Ticker is DS. Now this is I'm gonna have to label it as a speculative name, no question about it. It's only $2.80 or so. So just a high level view. This company was originally set up as a traditional golf operator where they owned, leased, and managed golf courses. They then sold all their own courses and now just lease them. But their ultimate goal is to reduce their revenue percentage in this segment and expand on their entertainment golf, where they operate drive shacks and eventually a new concept called the puttery. Drive Shack is a 55,000 to 65,000 square foot facility with 72 to 96 bays that provide a combination of entertainment and food and beverage offerings. So this is very similar to TopGolf. Company currently has 4 locations: Orlando, Raleigh, North Carolina, Richmond, Virginia, and West Palm Beach. Then you have the Puttery brand. That's expected to be a 15,000 to 25,000 square foot facility. It provides, a socially driven entertainment option that's centered around technology enhanced mini golf, along with food and beverage offerings. The concept is obviously going to be much smaller, and it's going to take advantage of more urban locations. If we go back to November, when the company last reported their earnings, we see that revenues were 66.5 million, which according to B. Riley came in above their estimate at 65.5 million and ahead of consensus at 59.8. And the upside here really came entirely from the traditional golf segment, because what you saw is the rounds of golf played increased month over month. It was up 20% in July, 21% in August, 26% in September. But in terms of the Drive Shack venues, most of them, operated at, essentially limited capacity, but they did generate revenues of 6 million through their 3 locations. Orlando was still closed, but they were going to reopen in December, and they did on December 18th. On the call, they talked about some of the sort of the new offerings that they had within the Drive Shack, such as a new 2-bay package, which debuted in mid-September. That drove some small event bookings. They're developing a new repeatable tournament model for guests. But then they also talked about, of course, the Puttery brand, which they're going to be hopefully launching later this year. They're going to launch them in New Orleans, Manhattan, Dallas, and Charlotte. And then yesterday, the reason why you saw the pop yesterday was because they announced a collaboration with PGA star Rory McIlroy. And within that press release, and this did surround the Puttery brand, but within that press release, it indicated that it expects to open its first location in Dallas in the summer, followed soon thereafter by a second location in Charlotte. So yeah, this is just a high-level view after we got a question from a client. This is a speculative play. If you want the more established name, you would then focus on Callaway Golf, which operates the TopGolf brand.
Interesting. First time I'm hearing this. Only 4 locations for this company.
Yeah.
Two in Florida, 1 in Virginia, and 1 in North Carolina. Looks, and the expansion opportunity is significant there, right? And the TopGolf model has essentially validated the space by being a pretty successful business model out there, which I still hope that one day it's going to do the IPO through SPAC soon, which so we can start trading that name. Supposed to happen anytime. Not a bad one. It's pretty good one because highly speculative, but it's only speculative in the sense because we look at this as stock and sometimes we just look at because it's low priced, right? And so it's $2.80 and we make just a normal judgment at that time is that, oh, it's low price, so it's got to be speculative, but maybe not so much. Maybe it's a growth story here that is finally emerging with a company that is low price today, not be low price tomorrow. What if they go from having 4 locations to 10 locations within a year, and then 20, 30 locations within the next 2 to 3 years to start to have coast-to-coast operations, maybe adopt a franchise model. A lot of things can happen. So this one is to watch because TopGolf IPO with the valuations will likely come in at the high end, is also like to, charge the bulls in this case too. One to watch, see if it could be a winner in the long run. There could be something here that we have not really paid close attention to. This is the first time covering this. So interesting name, adding to my watch list, and I'll be following this company from this point on each quarter, see what they have to say in the earnings report. All right, Steph. All right, guys, great stuff. Thanks for joining. That's it from us. Just be mindful, market internals are getting a little bit weak. You want to be a little bit cautious, have at least some hedges in the portfolio, in my opinion. And that's it from us. We'll see you in the chat room shortly.